Good evening. It's December 16, 2021, 9 days away from Christmas. It's 6:25 p.m. Thursday. Welcome to episode 27. Good evening to you, Wawi,
Good evening, Mark.
and good evening to our listeners. This is your host, Mark Yu,
Wawi Santos.
and this is the Mark Yu and Wawi Show. Disclosure: this show is made for sharing purposes only and not to be considered investment advice. We record once a week. And while we are both physical therapists here in the USA with the same passion and interest in researching and investing our hard earned money in the stock market. Show's goal is to share and learn from each other. We are available in YouTube, Spotify, and Google Podcasts. And for this episode, we have a good one for you guys. Um, as the title says, the hawk comes back. So this the hawk for newbies or new investors out there, hawk means the Federal Reserve is finally getting a little bit more aggressive in terms of hiking the interest rates, which in turn, as a result, there will be a little bit of tight money supply moving forward. Thus, it could affect the overall sentiment in the stock market. So we're going to take a closer look so far how the money is going or the stock market is doing. So for today, I would like to begin with this slide. We have the performance of different stocks, and it looks like this is a screenshot from FinViz for those who are interested who would like to take a deeper dive on this. But basically, it's showing that the big tech or those who are mega caps, as one would say, those over $1 trillion valuations are leading the downside today. But it's not like bloody red. It's not like sell off everywhere, but it's mostly the big tech giants that's pulling the market down. Aside from that, the rest actually are in the green, as one might say, which is interesting, right, Wawi? Because just yesterday there was a big pop. Nasdaq actually, or Nasdaq, which contains a lot of tech companies, actually popped 2%, but today it's down about a couple of percentage points as well, erasing its gains.
Yes,
Um,
Mark. Went down 2.5%. I
right.
was bullish this morning before the market opened,
hmm
and then it started going down.
For some reason, right? Probably the market realized, oh, I guess Jay
Mhm.
Powell has finally decided to be hawkish. We had to sell the tech or the big
Yeah,
tech.
some of them
Just
are saying it's going down with the treasury yields.
mhm. The thing about that is, in my opinion, or as also of what I've learned, big tech has been, the most outperforming sector, and the reason why is because they can grow, and they need the money to grow. The thing is, once interest rate starts to increase, then some of the tech companies would experience some trouble, or not trouble really, some difficulties in financing. But the thing is, I just realized here, Microsoft, Apple, Google, Facebook, Amazon, Tesla, these companies, they barely even need any external financing. So this may be again, a sudden shift in sentiment rather than fundamentals that just occurred today. So yeah, for the one day performance, technology leads the downside. For basic materials, financial, and energy, all of them are up actually. And not to worry, from the start of the year until present, it's still each and every sector is still up, led by energy. So we're going to go jump into the sentiments for the American Association of Individual Investors, which we regularly take a look at on a weekly basis. They just updated this yesterday. Um, so despite the initial reaction of the stock market, which actually increased or improved the moment Jay Powell released his statements yesterday, investors were a little bit were a lot more bearish as of yesterday. So from 29.7% bullishness, it dropped to 25.2 as of yesterday. And for the bears, from 30 and a half, it jumped by 9 percentage points to 39.3%. So the reaction yesterday was quite interesting, Maui, would you say?
Yes. Yeah.
Yeah. Mhm.
We've been seeing the um, the market go down.
Right. As of this as of today's close, market is red, led by big tech, as I've said earlier. So fear and
Hmm.
greed, we're still hovering the fear levels between 20 and 40. Quite a big difference from a month ago, which we were hovering a couple of months ago, which were always been hovering all-time highs after all-time highs. We are now near the fear territory. And the options market that we are now taking a closer look, the put call ratio. So put options are bought to prevent from any downside risk. So these are like, I would say, insurance. But yours truly don't do any put or call options trading. How about you, Huawei? Do you do any options trading?
No, I got my portfolio set up for options, but I have not done any options trading so
Right.
far.
So, well, looking at this chart, if it increases, it means people are getting more bearish, basically. So right now, the put call ratio is climbing. It's a little more high than what it was at back in September, which is quite an interesting find. So people are getting more bearish as of today. Fear and greed of the crypto market, Bitcoins specifically, we're at fear territory compared to last week's fear as well. So it's still overall the sentiment is a little bit gloom. I mean,
Yeah, I would say
gloomier.
more risk off in the stock market and
Right,
cryptocurrency market.
right. And volatility, obviously, market's been going up and down just for the past couple of days, and we're not done with a week. So 5% up volatility for the past 5 days. For the past month, it's up 20%. And since the start of the year, we're now trailing. We're a little bit elevated compared to the start of the year, but we're still down 24%. But in terms of since November, we've been experiencing some sell offs every now and then, and partial recovery afterwards. So we're trending up in terms of volatility. So this is a chart that we're gonna that Financial Times released just earlier. It's taking a closer look at what happened with Nasdaq. So obviously, big tech has been on a sell-off compared to the S&P 500 and the small caps. S&P 500 losing 1 percentage points since since this morning actually. Since this morning, it just lost 1 percentage points, while Nasdaq dropped almost 3%. This is in comparison to yesterday, where it had risen 2 percentage points. So definitely quite a sell-off from the big tech area. So the thing about big tech, Apple and Tesla, and some of them, the reason is they're like the outperformer so far this year. This is an article from Market Watch. Um, After being outperforming, Apple and Tesla actually are now expected to be the duds in the following year, come next year, according to Goldman Sachs. Um, so, according to this article, it's related to the downside that we experienced today. Um, Only 25 stocks accounted for 58% of the index gains. Um, just five stocks, Microsoft, Google, Apple, Nvidia, and Tesla contributed over 30% or a third of the S&P 500's 26% total return for 2021 through December 9, according to Goldman.
And
So,
that high concentration on
mhm,
those large caps
right.
uh, increases your risk,
Yes.
especially now that we're going into a um, shift in in
Mhm,
market leaders
right. Like
for
in
next year.
monetary policy wise, right?
Yes.
So if people are gonna hate on tech, more likely the big tech might feel some pain. But honestly, in my opinion, I think big tech will be around for longer. They have hundreds and billions of dollars in cash pile. So regardless
Mhm.
of what their stock price do, they'll just do whatever they've been doing for the past decades. And since they've been able to churn out positive free cash flow. So according to this analyst, Goldman Sachs, David Costin, he pointed out that market breadth has narrowed substantially over the past several months. In other words, investors have concentrated more of their money and risk in the largest tech companies by market capitalization.
Yeah. So this is what I posted on the group earlier.
Mhm.
I attended a Morgan Stanley webinar this morning via
Uh-huh.
Fidelity, and
Mhm.
we were they were talking about equal weighted large cap investment. So instead of the traditional investment that I've been doing using VU
Mhm.
and Fidelity's mutual fund FXAIX,
Right.
um, I've been looking at Goldman Sachs equal weighted large cap ETF. And if you guys need more information about this equal weighted large cap ETF, just look at my posting this morning
Mhm.
and you will see more information about that.
All right. Thank you for sharing, Wawi. And for those who are not part of the group, just shoot us an email at markuwawishow@gmail.com. That way we can add you to the group. So according to the analyst, even though that he's expecting that Tesla and Apple will be a dud, he says Goldman analysts continue to recommend that long-term investors own high growth, high margin stocks. So it'll still fall on Apple, Google, Metaverse, or Facebook for sure.
Mm-hmm.
So this is a zero hedge article. Um, barely 40%. So it just identifies that the top performing stocks are the big tech and the breadth is slimming. It's similar to the previous article that we just discussed. So this is a short YouTube clip, 46 seconds of none other than Jerome Powell being questioned by one of the CNBC hosts. Let's roll the clip. Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then what you would stop the taper potentially sooner, but it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
So basically, what they're talking about is tapering and raising interest rate by the Fed. So there's a lot of information within that 46-second clip. So basically, we are 2 months away from the Federal Reserve stopping or not stopping. Well, yeah, tapering or ending its bond buying program. Just 2 months away. By March, by March, we're done with the tapering. I mean, we're done with the bond purchasing.
Mm-hmm.
Um, and after that, he just answered that he won't be probably not doing any rate hikes until then. So that kind of gives us a small window to be a little bit, optimistic about the market in general. So maybe that's the reason why the market rejoiced yesterday, but realized that, there's only limited time. And so the algos are probably Wall Street, the Mr. Market, the
Mm-hmm.
ever, psychologically, uh,
Affected,
yeah, it's hard. Yeah. So that's why the sell
Mm-hmm.
off today. But yeah,
Mm-hmm.
well, so here's an article from CNBC. The Fed will halt asset purchases by March and hike rates in June. This is according to a CNBC survey. So
Mm-hmm.
obviously, the first one is true. So this is a fact. Jerome Powell already said that. The thing is, when is he gonna start raising hikes? And the thing about that is, the Federal Reserve stated that they're gonna hike 3 times next year, and not
Mm-hmm.
only next year but also the following year. So when are they gonna start hiking?
I think
Sur-
I
survey.
think they said every quarter.
If it's gonna be every quarter, okay. Yeah, that'll be because we have 4 quarters in each year. So if they stop, yeah, I guess this survey kind of match, kind of jives if they're gonna do it every quarter. The survey just says it might be starting on June, according to at least 31 respondents that have including economists, strategists, and money managers that participate in the survey. So June might be a good time, right? Wally? Who's who's to say?
Yeah, I think that's good. That's a we've been waiting for the Fed to taper anyway. We've been expecting them to start it earlier this year, but
Mm.
well, actually, I was expecting something to happen on the fourth quarter this year, but it did not. At least now we know where we're headed,
Right.
and the market always reacts when you know there's uncertainty, and
Mhm.
when now that we have a firm message. And what I like about what Jay Powell did was he set the expectation. He told us when, right,
Yeah.
and how, and by how much, so at least
True.
we know.
So at least with this kind of timeline that the market is going by and all of the investors and traders, they'll probably be less spooked. That's actually that's important because now we're kind of like being able to isolate what are the black swans or things that might come up. There are plenty of things that might come up. Obviously, the virus is still lingering around, so that's one thing to watch out for if it spreads. But yeah, okay. For the next slide, we have the initial job claims report. So we ended up with 206,000 jobless initial job claims, which kind of like did not exceed estimates because it actually the estimates were around 200,000. So we didn't meet the estimates. Continuing claims at 1.85 million versus estimates of 1.94. At least estimates have gone, at least the continuing claims have gone down a little bit. So some government sensitive data right there. Aside from that, so we just have this one before our roll the clip segment. So this is a graph showing United States NAHB housing market index. So this data was just released today, if not yesterday. So builders are actually optimistic. It edged up 1 point to 84 as for this month, the highest since February, beating market forecasts of 83 as strong demand met with scarce inventory. So this is interesting. Housing demand is still definitely there, as we have tackled for the past couple of episodes, despite that the conditions for buying a house and buying big ticket items have actually been negative for consumer sentiment. So builders are saying otherwise, and they're experiencing strong demand for new housing, which is a good sign. So looking at that data, it kind of brought remind me to check on this data from Chicago Fed National Financial Conditions. So the higher this graph goes, the tighter the financial condition is. The lower it goes, the better it is for financing. Financing. So right now, it's been trending up. It has been trending up since mid-October. So we're still in negative territory, meaning that financial conditions are still at ease, but it's slowly tightening for sure. This is absent any Federal Reserve intervention. Now that we're going to experience some, it kind of brings more attention how it would do in the next coming months, especially by March. So now we're at our roll the clip segment. So for this one, we're going to start off with the ever so bullish Tom Lee of Fundstrat. Are you ready for this one, Wawi?
Go ahead, Mark.
I think I'm not gonna be surprised what he's gonna say, but let's roll the clip. This is just fresh from the oven. It was published this morning, garnered 25,000 views.
You just heard one of my committee members call the move yesterday post-Fed nonsensical. Do you want to take issue with that?
Well, one-day moves in markets are hard to explain. So I don't blame Jim for describing it that way. But to me, the reason I thought the market rallied yesterday is that the rationale the Fed gave for why they sort of changed their view on tapering, plus the roadmap for potential rate hikes, is an economy that's normalizing with both demand shocks fading and the supply shocks fading. But at the same time, that framework included the risk that variants like the Delta variant slow the economy, and if Omicron has an impact, that they could walk back this framework. And that's very, that's a template that the market understands and agrees with and doesn't think there's policy error. So to me, I think it's actually a risk on roadmap that he provided, because it's sort of saying, look, unless Delta and Omicron and Omicron and other variants, don't sort of change the trajectory, the Fed could be tightening. But that's sort of what the market wants, is that a Fed that sort of still has the markets back.
Now, you're not trying to describe a Goldilocks environment, are you? Where even though we're having Fed tightening, it's what the market wants, it's what the economy can withstand, and yet it's going to be flexible enough in that environment. And by the way, we still have a lot of liquidity, even though they're doubling the pace of the taper. Let's not think that because they're doing that, all of a sudden the rain stops falling from the sky, right? They're still doing that.
That's exactly right. He said it several times that tapering is not tightening. It's just not adding accommodation, which is different than removing accommodation, which is what rate hikes are. And I do think the market wants the Fed to be a bit of an inflation watcher, and that's very clearly stated. So if inflation is not going to track worse than expected, then the Fed doesn't have to act faster. And then if we have sort of, as you know, this looming uncertainty because of these variants and the transmissibility, that's going to create the uncertainty that keeps the Fed a little more dovish. And I think post confirmation, which is in February, we could also have a change in the character of the Fed. But at the moment, it's important for Powell to be reconfirmed.
So you're sticking with your call. I mean, that's the bottom line. 4,800 end of this year, if not even stronger, and 5,000 into the beginning of next year.
Yes. I know the time window is really shrunk because we're essentially only 2 weeks left of the year, but we know it's a strong seasonal. We're watching South Africa closely, but as you know, last week positivity started to roll over, and we're going to check the regional cases, but as you know, hospitalizations barely picked up. And then if you look at some of the sewage data in some cities, there's some evidence that potentially Omicron's burn through a lot of areas. So Omicron's very contagious, but then it burns through, and people forget there's another side of Omicron, which is when it peaks.
Yeah.
All right. Ever so bullish Tom Lee, seeing 2% rise in S&P 500 within the next 2 weeks by year end. So, oh wow, I think you're on mute.
We'll see what will happen if he's right.
Yeah. And I think one thing that he highlighted there is the reconfirmation of Jerome Powell by February. So hopefully he gets confirmed, because he was already, picked by the president. So we'll see by then. And by March, tapering should be stopped, or at least by their projections already stopped by then. And then it might come to the discussion that overall the market would start to tighten, because they will slowly hike rates at least 3 times next year. So
Well, I think Fed Reserve Chair Powell, is the best one to stay
right.
As chair. Anyway, his vice chair is the one that Biden wanted to put in place of him.
Mm-hmm.
But I'm glad he reappointed him, because he has a good track record, right?
Right.
He got us over, last year, and now he's gonna get us over this year. I think we need a consistent leader on the Federal Reserve
Right.
to get us through 2022, which is
Mhm.
probably a transition period for the stock market here in the United States.
Yeah, and I think typically Federal Reserve chairs hold their position for at least 2 terms and they finish it. All right, this is the next roll the clip video. This is from Scott Minerd, one of the leading hedge fund managers out there. This is a Bloomberg interview titled "Minerd Sees Threat of U.S. Recession in 2023." So we jumped the whole 2022. And this is for 2023. This interview was just held yesterday. 2,000 views. Let's roll the clip.
Can I get your initial reaction to what we've learned in the last 10 minutes or so?
Sure, Jonathan. I think that everything we've learned today is pretty much, I think, in line with expectations of what the market was expecting. And I think that's why we see stocks kind of having a relief rally and then the bond market really having a muted response. But, I think Diane made some really excellent points. And I liked her comment about the high wire act that the Fed is on, because when you look at the data, you look at the shape of the yield curve, you hear the abrupt shift in rhetoric around inflation being transitory, and we see the dot plot with a very strong path of rate increases. I think that the market has not been priced for the worst case scenario, and based upon just the shape of the yield curve, for instance, which the Fed chose to ignore. Let's remember, they chose to ignore this prior to the last recession, that we are now setting ourselves up for a recession in 2023.
Whoa.
Yeah, that's a harsh prediction, but the gap between the 2-year and 10-year
Mm-hmm.
is really close.
Mm-hmm. The thing is also when he mentioned about valuations, it kind of brings into mind like currently I think the S&P 500 forward earnings is a little less than where it was back in June. So I'm kind of pulling up here for the forward price to earnings ratio by Yardeni. So I'm not able to share it on the screen, but currently it's at 20.9. So back in June, where we have been encountering a lot of all-time highs, it was around 22 to 23. So actually, we've been slowly, the earnings are finally able to catch up with the price increase. And now that slowly, hopefully price begins to be in check and earnings try to catch up, then I think it'll just justify that the market is just fairly valued, in my opinion. So now we're gonna be discussing a few companies that have came out with some reports. Like right now, we're gonna start off with FedEx. This just came out a couple of hours ago, 4:20 Central Standard. Federal Express reinstates 2022 profit targets. Shares soar. So looks like Federal Express is benefiting from the logjam in the logistics sector. So shares jumped 6.2% after hours, after reporting that they're going to reinstate their original forecast for next year. The thing is, what's interesting about this is I browsed this earlier. It said here, Tennessee-based FedEx now expects full-year earnings $20.2150, as it had at first forecast. So they're sticking with the forecast, obviously. But their net income here, adjusted net income was $1.3 billion or $4.83 share for this quarter that just ended in November 30, which is unchanged from last year. So earnings are flat, but Wall Street loves this for some reason. Usually it's the other way around, or if the company beats its earning estimates, but it looks like, revenue also increased 14%, but looks like, Wall Street is satisfied that FedEx at least will maintain its outlook for next year.
Well, I think the market reacted and raised, its its price on FedEx because FedEx increased its rates on
Mm-hmm.
its packages.
Right.
So it increases pricing.
Uh-huh.
That's why that supports their forecast for their revenue and earnings
Right. That's a
moving
good point right
forward.
there, Wowie. Yeah, I forgot about that. Yeah, they definitely did hike their collection or their fees for shipping. And as I went back to this article, interestingly, according to Cathie Robertson, president of Consultancy Logistics, quote unquote, FedEx delivery times are really lagging, and I believe it's due to their staffing issue. So on-time performance by FedEx is 85.7%, whereas UPS is 96.4 and USPS at 95%. So FedEx is definitely not delivering in terms of its compared to its peers. Regardless, Wall Street loves its performance. Currently, its valuation price to earnings for next year, forward price to earnings gap would be 12.7 times, which is a lot less than its 50% of its peers at 22.5 times. So it's still selling cheap. This is not a buy recommendation or anything like that, but
Mhm.
it's a little bit cheap. Year to date, its stock is down 6% at $238 a share, but it's now up $11 a share to 250 after hours. So tomorrow we might see a pop in this stocks and FedEx stock. So next company is Adobe. So this is an article from Seeking Alpha. Adobe's Christmas stocking gets stuffed with coal following disappointing outlook. So Adobe is actually the worst performing stock today in S&P 500 or Nasdaq, one of those indices. So it's down 10% for the day. The thing is, Wall Street investors were in Scrooge-like mood regarding Adobe as they drove its stock down as much as 9%, following a disappointing business outlook for the year. So Adobe reported that it expects to earn about $3.35 a share on revenue of $4.23 billion dollars next year, whereas Wall Street was expecting for it to earn $3.40. So the Adobe said it's going to earn 5 cents less compared to Wall Street estimates. And for revenue, Wall Street was expecting $4.36 billion dollars, whereas the company said it will be reporting 4.23 instead. So $130 million difference, but still they punished Adobe's stock terribly. So
Mhm.
it's
Well,
it's not a good amount, but Mhm.
that's kind of like what happened to DocuSign, right? But
Right.
is Adobe still like $300 billion market cap, or
Oh,
is it
that's a
more
good
than that?
question.
Oh
For
yeah, it
the
still is. Yeah, I can see it
Mhm.
on that headline.
Oh, okay.
So
Yeah.
so it's still pretty good, right?
Yeah, it's definitely a big company. Yeah.
It's a strong company,
Hmm.
uh, it's it's got a good innovation funnel. So I
Right.
think if you're a long-term investor, I think, if you hold,
Hmm.
and then that's not an investment advice. I
Right.
don't have Adobe, but
Uh,
you know, I think that this company is gonna hold, would be a good hold if
right.
I
I
had
think
it. If I had it.
yeah, I think I have a small amount in Adobe too. Just because YouTubers they use a lot of Adobe to Photoshop.
Mhm.
Well, I myself I don't use Adobe to modify, but we only use Zoom. But yeah, I think Adobe is the best one out there to modify video content and upload it. So its valuation is at an astounding 63 times earnings for next year. Very pricey compared to its 50%, 50 half of its peers at 30 times. So nearly double. So Adobe for the year, it's up almost 17%, 566 a share, which what we pointed out at $269 billion market capitalization. It's quite a
Well,
big company.
actually, 299.91.
Oh, 299.
And looking at its earnings per share trailing 12 months, it's $12.21. And compared to the S&P 500 performance, the past 5 years.
Right.
Wow, look at that difference. Anyway, I think it's a it's a good company. It's a big
It's a good
company,
company. Yeah, it's a reliable
and
one as well. Mhm.
we use their document uh, formats and
Mm.
and
Oh yeah,
all the time, right?
PDF files. True. Yeah.
Mhm.
So next up is Booking Holding. I think we only will be discussing at least 5 or 6 companies. We haven't done this in a while, so
This is
listeners, you're in
good.
for a treat, I guess.
Yeah,
Yeah.
this is good. I like this.
So this meanwhile, this company is Booking Holdings. This was published this morning, according to Seeking Alpha, tracks higher after RBC points to positive trends. So RBC is an analyst. So RBC Capital Markets upgrades Booking Holdings to outperform after having it slotted that sector perform, quote unquote. We believe a host of both positive industry and company developments combined with an expectations mismatch have created an opportunity in Booking, prompting an upgrade. Number one, underappreciated structurally, higher profitability versus pre pandemic, minimal exposure to the subtle direct booking trend our US property manager checks are detecting. So it's still quite technical there, but I guess everything about booking just means that people are going to be traveling more. At this point, RBC is just highlighting that the Wall Street is not appreciating booking as a stock or as a company. So it's forward price to earnings. Wow, look at that. 84 times. 84
Mm,
times price to earnings ratio
way up
versus
there.
versus its peers at 16 times. So definitely in the pricier end, regardless that the valuation alone didn't deter RBC. Aside from that, they're actually saying that the market is not appreciating its stock. Meanwhile, for the year, Booking Holdings is actually flat. So it hasn't done anything to reward its shareholders so far this year. It's been stuck. Now it's currently priced at $2,164 a share. So next company, oh wow, look who we got. Robinhood.
Yeah.
So according to Bank of America, as of this morning, they're rating Robinhood an underperform as their first coverage on COVID tailwind reversal. So that's not a good sign if a company is actually experiencing some fundamental reversal. So according to this analyst in Bank of America, Craig Stegenthaler, messed up the name pronunciation there, apologies. They initiated underperform on Robinhood as he thinks the market isn't accounting for the reversal of COVID-19 related tailwinds, its overstated growth trajectory, and regulatory risks to its payment for order flow model. So back in February, Robinhood was definitely in the hot seat as it froze a lot of accounts trying to sell AMC and GameStop during that point in time, the meme stocks.
Mhm. And it hasn't posted any good earnings.
Oh yeah.
It's
hmm
um since they IPO'd.
They're
Um,
still experiencing losses for sure.
but their debt levels are not that high.
Right,
You know, total debt over capital is 18% at this
right.
time.
So it's not likely that this company will go bankrupt at this point in time. And
Hmm.
further, according to the analyst, he said that the growth in Robinhood will be harder to come by. The stock
Hmm.
and crypto trading app, or Robinhood, already has 23 million accounts against a population of 66 million adults in the US aged 20 to 34, its target market. So already almost has half of its accounts or user accounts already signed up.
My
So,
perspective on this is, as its retail investors become
mhm,
more savvy,
right.
just like just like us, we're gonna look for a better exchange to do our trading that offers more research.
Like a better
Uh,
brokerage. Uh-huh.
yeah. So they have to compete on that. What edge can Robinhood give their retail investors? That's
Right.
the question, right? How can they sustain that?
Right. And they're still pretty young. According to Wikipedia, they were introduced back in March 2015, as compared to, let's say, the big wigs out there,
Mhm,
like Fidelity, Vanguard,
mhm.
IBKR. I have my account
Yeah.
in IBKR, so I have to disclose that. Uh,
Mhm,
Bank of America, Merrill Lynch. So yeah, Robinhood has clearly did not return any positivity to its shareholders since it listed in the stock market. So since it went public back in July 29, it's down almost 48%. Or investors since day one have lost at least nearly half of their investment. So this is quite interesting because back in November 9, as Robinhood was experiencing some selling, Kathy Bay
mhm.
started buying some shares, and ever since then, oh my! So even back then, it was trading around $34. Now up to now, it has lost 47%. So Kathy Wood was buying at that point. I'm not sure if she already sold some of those shares or if she's still holding the bag. By the way,
Yeah.
Wawi, did you see that article regarding Kathy, like ARK Investments not holding onto their investments as they were saying they were actually selling or, trimming their positions? Have you seen that
Mhm.
article?
Well, I've been following their buy and sell
Hmm.
um, um, trading, and yeah, it looks like they sold a lot of Tesla. Um, they're just actively moving a lot of their holdings back
Right,
and forth. What I'm seeing consistently is they're buying a lot of PagerDuty and
mm,
UiPath
right.
uh,
Oh,
company shares. So
so here's the article. I'm gonna try to pull it up, but it says here, Kathy Wood sells ARK's high conviction names, even as she implies it's time to buy them. So that's quite interesting. Let me pull up the article right now because I think I just skimmed through it yesterday, and it
mhm,
was released. It was a study by Seeking Alpha. So they're deeply looking into how Kathy was doing her investments.
mhm.
So
Well,
according
it's
to
out.
Mhm.
It's out
Okay,
in the public.
right.
You could see what she's buying. What ARK is buying and selling.
Hmm. So while we were waiting for that article to pull up, let me see. Okay, here it is. So Wood told Bloomberg TV in an interview last week that, quote unquote, especially in periods where our style is out of favor, what we usually do is consolidate our top holdings or holdings towards our highest conviction names. Those are names in our top 10:
Mhm,
Tesla, Roku, Teladoc, Square, Shopify, and so forth. And according to this article, however, a review of trading records that ARK voluntarily releases every day, like you said, Wowie, they release it every day, shows
mhm.
that Wood hasn't actually been buying any of the high conviction names she mentioned, other than Roku, and
But
has
guess
instead dumped shares of Tesla and Shop. Mhm.
but guess what she bought today?
What did she buy
Uh,
today?
Robinhood.
Oh,
About 363,000 shares of Robinhood.
wow, that's a lot. So she's definitely trying to catch a knife here. No, hopefully not a falling knife. But
Well,
yeah.
she caught Robinhood while it's falling,
Oh yeah,
and
back in
just
November 9. Mm-hmm.
yeah. So looking at December 16 buys on the ARK uh, fund. Uh, I mentioned Robinhood 363,000, Verisite 109,000, PagerDuty 68,000, Stratasys 46,000 shares,
Mm-hmm.
UiPath again 22,000 something shares,
Right.
and sold 3D Systems, 36,000 shares of 3D System, uh, and then sold Iovance Biotherapeutics. And for the ARQ, they bought Materialize, 31,000 shares, and on ARCW bought NU Holdings,
Uh-huh.
229,000 shares.
Wow.
Anyway, what I'm seeing consistently is she's buying a lot of PagerDuty and UiPath. Uh,
Those are like
and
high flying growth names, right? Like big
yeah, those are growth stocks.
growth stocks. All right. Well, that's interesting. Well, ARC Innovation in particular, ARKK, investors are not liking it so far. Every stock has actually almost been suffering some sort of like downtrend recently. So for
Mhm.
ARC, I just checked it right now. For the past month, it's down 20%. And since the start of the year, it's down 26% for those who are interested in ARC innovations. So this is,
Um,
oh, go ahead.
Look, so so if you were an investor back in 2019
Mhm.
December, which is when I bought my 3 shares of ARK Invest at that
Uh-huh.
time, it's up 77% still. So for
Right,
early investors, you're still a little bit ahead.
right. Yep, that's true. December, yeah, I got here to at 20, 80%.
Mhm,
Yep, quite a return right there, almost double. So this is
mhm.
just a tweet that I saw this morning, which is interesting. Some guy named David Morgan on Twitter at SilverGuru22 shared this post. He actually took a closer look on Jim Cramer, CNBC's Jim Cramer stock picks. If
Nice.
you had followed his advice since the start of the year, and what are they worth now? If you're
They're all
gonna
red.
look at the right side, yeah, all of them are down. Not only half, but some of them more than that, down 57, 59, 64, 72%. So this
Yeah.
this list includes Veru, Workhorse, Fastly, Affirm, Viacom's Skills,
Mm-hmm.
Plug Power,
Mm-hmm.
Root. I'm not F Cell. I'm not familiar with others, but yeah, if you follow Jim Cramer's each and every stock pick since the start of the year, you'll be losing more than half of your money. So just watch out.
Mm-hmm.
I mean, not everyone is perfect, but so this is an interesting. You're a monthly full subscriber, Wowie.
Mm-hmm.
So this one is taking an article from from your news source for sure. So this
Mm-hmm.
just I saw this a couple days ago. December, it was published December 14. The title is America's Billionaires Are Cashing Out Their Stocks Like Never Before. So I mean,
Mm-hmm.
this is already a fact that we already discussed a couple of episodes ago, where the big tech giants,
Mm-hmm.
the Larry Page, Sergey Brin of Google, obviously Elon Musk, as I think now he's up to 13 billion, right, of Tesla stock that he had
Mm-hmm.
sold.
Mm-hmm.
Bezos, I mean, Bezos have been selling regardless. I mean, at least 10 billion a year, but definitely a ramp up this year so far. And obviously, Zuckerberg of Metaverse or Facebook. So these guys have been selling hard. Um,
So what can we learn from these CEO billionaires,
mhm.
right?
The-
They're
mhm,
teaching us to, stick to our plan, right? So if you have a
right.
plan to like harvest your earnings at a certain percentage, go ahead and do it.
Mhm,
Just you're dealing with algos. I mean, you're competing with algorithms all
right.
the time, right? So robo trading,
Mhm,
uh, and when uh you just have to stick with your plan. Okay, if it goes up 20% or whatever your price target is, stick with it
right.
and rake in your profits. But
And
unfortunately,
uh,
because of our tendency to you know to expect more, we're hoping, or a little bit of greed, or you know
right.
we expect more earnings, we
Mm.
fail,
You
right?
don't want to take the chips off the table. Just keep
Mhm.
keep it
Keep
there until
betting.
it goes down. Yeah, and that
So
would
stick to
be.
your plan.
Mhm. And the thing is, I think one of the CEOs also, Microsoft, sold half of his options. I think, which net him a lot of money. I think it's something to do also as well with the uncertainty in the tax environment coming next year, because I think
Mhm,
they don't want to pay a lot of taxes and all that. But regardless,
mhm. Yes.
they're not selling at a bad time. Definitely, this is the optimal time as people are piling in the stock market, record highs of exposure, and a lot of people are still going in and buying the dip as of this time. So, next company we have, I think this is the second to the last company that we have today, Netflix. So, this is an article from Seeking Alpha published yesterday. It says Netflix price target lowered at benchmark. Valuation is vulnerable to inflation. So, analyst Matthew Harrigan said Netflix is more of a media name than a moated category killer tech entrant. Hmm. Highlighting advantages in quality of service, user interface, and data science, but its creative execution remains erratic, citing the quick cancellation and dismal Rotten Tomatoes for Cowboy Bebop, even if Squid Game became a global phenomenon earlier this year. The thing is, okay, there's some more. It is unclear how event projects like Red Notice, Netflix most viewed movie ever, despite mediocre reviews, enhance member growth versus original series or evergreen intellectual property like Seinfeld. What's your take on this, Why? What do you think of his call? Generally, Netflix is vulnerable to inflation.
Well, um, I just I just don't know. I don't know how to predict, right?
Mhm.
Netflix for me, since it's a global company,
Right.
has a lot more moat than
Yes.
Disney.
Right.
But Disney is popular here in the States. But Netflix is global. It's got a global market. Um, so far, I don't see any competitors, right?
Well, there are several like Peacock, HBO, but none to the size of Netflix. I think Disney is the only one that's coming close to it.
Hmm. And
In my go ahead.
Amazon
Right,
Prime Video is not very popular either,
right.
in
Oh
my
yeah,
opinion.
I think YouTube actually is the number one competitor. The thing about that is, Wawi, I also kind of in my take, I'm disagreeing with this call that Netflix is vulnerable to inflation, because I think he's picking that up from what Netflix had done the other day in India, where it had to kind of, instead of hiking it their rates, monthly rates, they kind of dropped it a little bit to match what Amazon is doing in that area. But overall, I mean, Netflix is now net free cash flow positive
Wow.
just for subscription. I think they already announced that a couple of quarters ago that they said that they will no longer need to reach out financing or take in more debt, unlike before where they were like mostly in debt. So
Well,
they're right now they're generating positive cash flow. So I don't know why the negative take on Netflix here.
its CEO is still, showing good performance. He's got a 94% approval rating.
Cool, yeah, that's nice.
And looking at the market cap that it has, 268 billion with a return since IPO of 50,000%
That's amazing.
and annualized returns of 37%. I think Netflix still has room for growth. It
Right.
has it could still increase its total addressable market.
Mhm.
Um, there's not everyone has internet yet.
Right.
That's what I'm saying.
Right. And now I think they have reached a point where they have enough subscribers, paying subscribers, to sustain
And I'm
their
one of them.
likewise. Yeah.
Mhm.
So I think I mean, regardless what the stock does, I mean I'm happy because I myself as a shareholder. And looking at their balance sheet as of September as this year, they had like $7.5 billion in cash and roughly around 3 billion. No, wait. Oh, wait. Okay, 14.8 billion. So quite alarming level of debt, around 15.5 billion, but 7.5 billion in cash. So they have quite a good amount of leverage in their balance sheet. So, but in terms of their free cash flow, which I'm clearly leaning on to as my bullish call on the stock,
Mhm.
they'll be able to sustain their long-term run. They'll probably still come out with some crappy movies, I guess, some crappy series, but
Mhm.
every once in a while they'll come out with those Korean one, big hits like the Squid Game, which would attract more
Mhm.
member signups. Or their moat for sure is sticky in my opinion. So Netflix since the start of the year is up 13%. So this one, Qualcomm. Oh, next stock is Qualcomm. Morgan Stanley came out with their top semi industries or semiconductor pick for the coming year. It's Qualcomm listed as top pick on growing auto and IoT or Internet of Things business. According to Morgan Stanley, he has raised his price target to $215 a share, or 18% higher than today's stock price of $178 a share. As smartphones, an area where Qualcomm has significant exposure, are likely to see fewer supply chain disruptions. So this is a call where logistic jams are going to ease by next year. The analyst also believes the company will benefit from significant price increases that have continued around 5G. So it looks like a bullish call definitely for Qualcomm, 18% upside from here.
How did
Just
it do today? Do you have
mhm.
its what do you call this? Its earnings today?
Oh, I'm not sure. I don't think they released any updates on Qualcomm. But we're gonna
Okay.
get back to it in a little bit for sure. Whenever we have the information. So
Mhm.
this is a recent filing that they made as of September 26. Uh, Interestingly, they have the we have 2021, 2020, 2020, and 2019 revenue here. Even during lockdowns, Qualcomm was selling a good amount of equipment and services. It nearly grew almost $2 billion to 16 billion. But yeah, its business is still growing, and what's more important is its balance sheet. So we're gonna take a little bit of a dive in that. So Qualcomm's cash and marketable securities as of September was hovering around 12.3 billion dollars, whereas its long-term debt is 13.7 billion plus 2 billion short term, 15 billion in debt with 12.3 billion dollars in cash. So a little bit leverage here for Qualcomm. And in
Well, that
terms, Mhm.
Qualcomm is a favorite with
Uh-huh.
a lot of these index funds.
It is interesting, yeah. Okay. I think at one point they were trying to be acquired by Broadcom, right? I think last year until I think DOJ filed a case, antitrust case, and they have to pull back. But Broadcom, I think, was at one point trying to acquire Qualcomm or vice versa. Let's see. Broadcom acquire Qualcomm. I think it was the case. Yeah. Broadcom proposes to acquire Qualcomm. This was back in 2018, even before the pandemic. But it didn't occur because I think they faced the antitrust allegations, so they didn't pursue. Mhm. So in terms of valuations, Qualcomm forward earnings currently it's trading at 20 times earnings compared to its 50% of its peers at 30 times, which is interesting. So it's kind of selling a lot less, and not a lot less, but you know what I mean, a little bit less compared to its peers. So since the start of the year, Qualcomm skyrocketed at least 20% since the beginning of the year. I think we lost Huawei at one point. We're reconnecting. Hello, Huawei. You there? So while we're waiting for Huawei to get back online, we have an article here. Hello, Huawei. You're back. So right now, while Huawei is, we were trying to get some audio in. This is an article from Barron's that just came out a couple days ago. Wholesale prices rise at the fastest pace on record. So this just means that prices overall, buying goods and services are increasing. Producer price index rose 9.6. Yeah, we can hear you now, Awi. Welcome back.
Okay, I just had a glitch there. Sorry.
You're good. You're good. So U.S. producer price increase rose 9.6% from last year, ahead of estimates of 9.2% rise. This is the largest jump since the calculation was started back in 2010. So no sign of slowdown. Wholesale prices 9.6% higher in November, 8th consecutive month of record increases. Whew. So definitely inflation is knocking on our doors. I think Federal Reserve was only targeting 2% to begin with, and now we're at 6.8%. But according to Bill Lackman, as I've shared earlier this week on the group, he actually, or last Friday, it was actually around almost 10%. There's a CPI, considering other information. Nonetheless, U.S. retail sales, excluding autos, month over month, has only risen 0.3%. This is quite not a good finding or not a good data. It means that there's a slowdown in retail sales. Well, we've been actually looking at consumer sentiment for a while now, me and Huawei. And if you're following us from our previous episodes, since October, interestingly, now that I recall, the financial conditions by Chicago Fed has started tightening. Since October, consumer sentiment has actually been going down. So now we're slowly experiencing it in actual data. Retail sales of 0.3% compared to an estimate of 0.9% increase. So this is not an alarming finding. I mean, consumer retail sales can still bounce back up. If you're going to look at a chart here provided by Trading Economics, we're still in the positive territory, but definitely a slowdown for the past year. If you're going to look into past half decade or 5 years, we are still trending in a positive territory. So we're still a little bit in a slowdown, but not like in a negative, like troublesome period. And of course, personal savings rate. Excuse me. So as of October, it's down to 7.3%, back to pre-pandemic levels. So we already tackled a couple episodes ago that consumers are now using more of the credit cards to finance their spending. So this is just an article supporting the previous finding that we just had, the slowdown in retail sales, suggesting drag from inflation. So definitely inflation has influenced. Also as well, I think while we discussed the pull forward, like people buying early for Christmas to avoid their log jams in delivery time, right?
Well, it was definitely encouraged for people to buy early for Christmas because of the supply chain shortage. But what I would like to see is, would it push through till next year? Would we see more consumption next
Right.
year compared to this year? Now, in comparison, the European market is expecting consumption rates to increase.
Uh-huh. Okay.
But in the United States, there's probably some doubts on that, including the housing market,
Right.
because of the high cost,
Uh-huh. Inflation wise, yeah.
inflation wise.
And here's a chart provided by Charles Schwab. So this is a small business optimism index. So they're going into negative territory. Well, not negative, but going down, slowing down a little bit. Well, what's more troubling here is the outlook for small businesses. Looks like it's way down for its outlook in the coming year. So that's one thing to watch out for. Now the consumers are showing their disinterest in buying big ticket items and such, and now it's reflecting on our retail sales. Remember that U.S. economy is 75% or 70% fueled by consumption, so it might be a slowdown coming pretty soon. Was I think I included this for a mistake, but I guess this is just a meme that I saw on Twitter. So it just shows that when you get a raise, when you get a 3% raise, but inflation is 5.4%, x 6.2%, scratch that 6.8%. So definitely inflation is hitting employees, hard workers pockets as well, because yep, it's getting more difficult now that people are trying to fund. Some spenders are using their credit cards to finance their consumption, which isn't good. Which is not a good idea over the long term if you're unable to pay for your credit card balances, and interest accumulates. So that's a troubling sign right there.
So one of the things I'm thinking about is how much savings is still available for people to buy things.
Right.
How much of the M1, M2 is still out there for
Okay.
consumer spending.
Yeah, that's one thing to watch out for as well. Because M1 and 2, I think right now it's still hovering a little bit elevated because of the stimulus that came in and the Federal Reserve providing support. Which right now we're slowly seeing some tapering, not tightening, according to Jerome Powell. It's not tightening until they start hiking rates. All right.
In the banking market, one of the things I saw and read today was that banking regulations, stricter banking regulations regarding derivatives, is forcing some banks to hold more capital.
Like retaining more tier capital ratio in terms of their balance sheet.
So definitely some more headwinds here.
Right.
We got a lot of demand. Home prices are high.
Right.
But there would be some friction towards lending or borrowing.
Right. So that just reminds me, Wowie, that we're slowly definitely experiencing some financial tightening around, like they're knocking on our doors right now. And consumption is a little bit slowing down as well. Yeah. So well, Wowie, do you have any quote for us for the week?
Well, I don't have any quote, but make sure you have some cash reserves.
Right.
For the rainy day.
Yes. Always be prepared. Well, Wowie, thank you so much for coming on Thursday evening, and I appreciate your time this evening. Listeners, that's it for this episode of Mark Yu and Wowie Show. If you have any questions, just send it over, markyuwowieshow@gmail.com. And remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
Wowie Santos.